We're now going to cover time management and profitability together, because being in a world of advertising and marketing, a business that we sell time, we cannot look at them separately. One thing that I think every single advertising agency is very bad at is reconciling time and doing timesheets accurately and effectively. For all purposes, I think it's a bit of a pain for most staff members to go and record their time every single day, every week, every month. And it's a big challenge for us because we can't report correctly and accurately without actually reconciling time. So our agencies put together kind of what we saw as an incentive to make sure that staff actually do their timesheets. And I think about 4 years ago, we said to staff, if you do your timesheets every single month and your timesheets are accurate and they're correct, you will be paid your salary on the 25th of the month. If your timesheets are not done and they are not complete and they're not accurate, you'll be paid your salary as per our usual salary run on the last day of the month. What that has done is it has ensured that timesheets are done in a timely manner. The biggest concern that we still have is the accuracy of the timesheets. And that is really where we base we put a lot of responsibility on the different business directors and the suits / account management on those specific jobs, because they're the best people to be able to actually gauge whether the staff that are working on the jobs are allocating their time accurately. And ultimately, each job is for each account manager or business director to own. They're the ones that have to report on their profitability on their clients. They're the ones that actually maintain the relationship with the clients. So if you've got a creative, for example, he allocates 100 hours to a specific job and it wasn't valid and he actually forgot what he had done for the previous month, it's up to the suit to raise the flag and say, that shouldn't be on there, and actually go and make the creative move it and put the pressure on them to actually account for their time more accurately. So whilst we can ensure that timesheets are completed every single month as a result of paying staff a few days early, we are still struggling to make sure that the accuracy is 100%, and that's where we're working very closely with our head of operations as well as the suits and the account management team to make sure that they own each job and they own the relationship with the client, so that they can go back to the client and say, you bought 500 hours from us, here are 510 hours, and I can tell you that the 510 hours are complete, they're accurate, and they're 100% valid, and here's why we went over by 10 hours. We have worked with the Chase team to build a really robust profitability mechanism and report on Chase, which we've been testing for the last 18 months. And the basis for profitability is time, ultimately. And I'm going to speak to you about how we have worked on this profitability report and where we are. We're probably about a month away from actually being able to roll it out to all of our operating companies. So, what have we done? We have got a job. In that job, we have got cost estimates. Cost estimates, remember, we sell hours and we sell hard costs. Hard costs are quite simple. We either go in flat or we have negotiated with the client that we can charge a markup. So profitability on hard costs should be very straightforward, as long as what we have, the purchase order that we have given to the supplier is actually the same as the invoice that we receive. We don't want the client signing off a cost for 100 Rand and for whatever reason the supplier's invoice comes in at 150 Rand and we haven't either managed it correctly with the supplier or with the client. But I'm not going to focus too much on hard costs because that is relatively straightforward. What I'm going to focus on is hours. So what we do, we've got the job, we've got the CE. Attached to the CE are estimated hours. Now, every single day, we've got a lot of team members that are logging hours. And they are logging hours to clients and to jobs. And it is critical that they are doing it correctly and accurately. At the end of the month, what we do is we then reconcile the revenue that we have generated to the hours that have gone against every single job or every single client. So right now we're looking at a bit of a bird's eye view, so we're looking per client. So we say number of hours per client costed at the rate per employee. So my staff, my head of payroll, at the back end of Chase, every single month, she goes and updates the actual cost to company per hour of every single employee who's loading time on jobs. So that the system says, Joe Soap has allocated 50 hours. This is the cost of Joe Soap's 1 hour, and it says 50 hours times his rate per hour will give you the actual cost. of those 50 hours, just the direct staff cost. It's really important to note there's many other costs other than just the direct staff costs. So what we have done is we've run a lot of different models to say, how do we account for leave? How do we account for public holidays so that at the end of the day, we are actually equaling 100% of our staff costs? We've decided to add 17%, and that's really a group standard in terms of our profitability, where we say we take his cost, we then add 17% onto that cost to account for leave, to account for public holidays, and anything where, for all purposes, he cannot be accounting for time. Really, it's just taking his cost and making sure that we are balancing back to the 100%. What we then do is, so we don't just have we don't just have the costs of the people that are actually delivering against that work. We also have a group of people who don't do timesheets. Myself, I'm one of them. I don't allocate time against jobs. I provide far more of an oversight function. My team as well. So what we have done is we have taken all the team members that don't actually allocate timesheets, and it's apportioned accordingly per every client's contribution to revenue. Then what we do is we take our total overheads and we say, okay, we've got a certain amount of overheads. How do we actually apportion each of those to every single client? So what we do again is we take each client's contribution to revenue and we say, okay, if you have delivered 15%, this client's contribution to revenue is 15%, then we allocate 15% of our total overheads to that client. So we say revenue minus direct staff costs plus 17% minus indirect staff costs allocated in relation to that client's contribution to revenue minus the client's contribution of operating expenses gives you profitability per client. Sounds quite confusing. I promise it's not. And Chase delivers a really, really strong and robust spreadsheet in order to do that. It is important to note there will be some anomalies, but we have run this for the last year and we've tried a number of different means and measures to do this, and we've settled on this as the most accurate way to, number one, be able to establish what are the clients that are delivering really great revenue and where are the areas that you need to be focusing on to turn clients who potentially are just contributing to overhead to make them green so that they're actually delivering against profit, and where you've got red clients that you are over-servicing or that their margins are too small, or perhaps it means that you actually need to go and renegotiate with the client because the contract that is currently in place is not profitable. One last thing on this is that it's really critical to note that you will have a lot of staff members who don't allocate 100% of their time to clients. And we have got something called an internal job bag. Internal job bag might be proactive, it might be awards, it might be new business, but it could also just be staff members not doing what they should. And it's really important to stay abreast and on top of that allocation or that job, so that you can actually say, okay, but I have an expectation that this staff member should be delivering 90% to paying clients, and actually 50% of their time over the last 3 months has been going to an internal job bag, which means that 50% of their time is for all purposes an opportunity cost. It's a sunken cost that we are not recouping from clients. And what this report also then allows you to do is it allows you to have the right conversations with the right people or the right clients so that you can be making sure that you're extracting as much profit as possible.